Okay, what the hell happened yesterday? All right, I was flying across the country looking at real estate like I usually do. And what happened? Well, we got jobs data, which initially was great. All of a sudden, 10-year treasury yields fell, stocks were going up, and then all of a sudden, everything U-turned. The market crashed towards the end of the day. Everything went to crap. And now I'm going to get the comments to be like, oh, Kevin thinks, 0.5% decline is a crash. I'm just not even going to address it. Okay? I had fun on my little Tim Pool podcast. He's a great guy. So what do we have over here? All right? 10 reasons why treasury yields skyrocketed yesterday. And then we need to get into a Nick T piece here. Hollywood strikes and the yellow corporate bankruptcy cut $54,000 from the August jobs. Without that, non-farm payroll would have been closer to $240,000. We have trend of $187,000, okay? And that's including pre-COVID. We need to be below that to convince the Fed that we're good. We've reached a high enough level. That's what Jerome Powell told us at Jackson Hole. When you add these back in, you're at 240, hotter than expected. Obviously, we expect a downward revision in the future, but a little problematic. The decline in average hourly earnings in August was probably temporary because there were fewer days in August, and the way they calculated it took some of the benefit of the decline in pay in August away. The slight rise in hours worked in August gave credence to the Chicago PMI report, which basically suggested, the economy is actually doing pretty decently and might actually start improving here, which also reiterates why the Atlanta Fed real GDP now number is, I think it's now at Fed now GDP at 5.4% or something, 5.6 as of September 1 after the jobs data. It's like, on one hand, the economy's doing so great. On the other hand, everything's gotten so expensive and consumers are pissed and feel like they've hit a wall. And then here you are having the suits telling you, oh, nope, everything's great. See, look at GDP. It's killing it. No recession here until something breaks, obviously. The slight rise in hours worked in August gives credence. Okay, yeah, I talked about that already. We got ISM manufacturing saw an increase. We got money managers saying, basically, hey, we're going to be higher for longer. So, let's price this in. And this is why we're seeing yields rise. Mortgage origination picked up. We've got oil rising, which is an inflationary pressure. And on top of that, we've got Loretta Mester talking about, it's still too high. All right. Then we've got Nick T over here. So we're going to analyze what Nick T is saying as well, obviously. But let's understand a few things here. First, it's really important to understand that the stock market right now really wants to see a finish to the rate hike cycle. We're probably going to be higher for longer, and as long as nothing breaks, there's no reason for the Fed to cut rapidly. They're going to keep the boot on our neck for as long as possible, certainly at least to keep our expectations low that inflation might rise, right? That's important. So what do we have here from Nick T? Steady hiring, robust consumer spending offer latest evidence the pandemic's effect of the unprecedented upon us, basically all the money printing, right? Suggests that the economy is still surprisingly resilient. Fine. I actually think the title is very interesting. Resilient U.S. economy defies expectations. This is put together by Nick T. And so what he talks about in this article is how, look, the economy is not trending towards recession, at least at this point. And something could break, but one of the reasons we're seeing a lot of extra money circulating and business still boom is the Inflation Reduction Act. Remember that included about $383 billion for energy spend, which Goldman Sachs says, because of loose treasury interpretations, is probably going to be more like $1.2 trillion. You've got the CHIPS Act, which will probably also be inflated to like $200 billion of spend, boosted federal spending, construction's up. Basically, the economy's still doing pretty decently. I mean, look at the end over here. If you go to the end of this particular article, they're like, wait a second here. Recent data have been very positive for a soft landing view, lower probability of recession. Again, obviously, in the event something breaks, all of that goes to poopy doopies. But what's happening? Well, one of the reasons, all of this combined, suggests that we had a market yesterday that said, damn, we thought we finally got a good jobs report. We thought we finally got a weakening report that implied the Fed might be done. And Jerome Powell told us we needed to see this. Where did he tell us this? Right here, Jackson Hole. He said, additional evidence of persistently above trend growth could put further progress on inflation at risk and could warrant further monetary tightening. But in addition to that, we expect labor rebalancing to continue. Evidence that tightness in the labor market is no longer easing could call for a monetary policy response. Well, unfortunately, the jobs data we got looked like easing. Then, when we actually added back in the strikes and the yellow trucking bankruptcy and the fact that the wage pressures in August were potentially reduced because of fewer days on the month, working days, all of a sudden people are like, wait a minute. When we actually adjust these numbers, things are actually still hot, at least until they get revised down in the future. That means we might get another rate hike. And so, again, the initial impression was great. Then people remembered what Jay Powell said, which what did Jay Powell again say? Evidence that tightness in the labor market is no longer easing could call for a monetary policy response. That started pissing off the market right there. Nick T actually put it pretty eloquently. Look at Nick T's other piece here. Job gains eased in summer months. Unemployment increased. Oh, it's Nick T just retweeted this piece, but somebody else wrote it. Hiring slowed this summer. However, the readings from Friday's jobs report won't resolve the debate about the November to December date or rate hike. And the reason for that is, even though the unemployment rate went up, reflecting more Americans seeking work, a higher participation rate, more employees are holding on to workers. This is a pretty normal number. This is not a weakening number. The yellow bankruptcy, the strike, without those, you'd be closer to a 240,000 job gain. And Jerome Powell, again, reiterated that if we didn't see loosening, we would hike more. Such rebalancing remains incomplete, he says. You have mixed signals on consumers. Some companies like Macy's, Best Buy, Home Depot suggesting there's some pain, Dick's Sporting Goods. But people are still kind of like, hey, things aren't really soft over here. In fact, you've got a company like this one, which is a sawmill equipment company, and they're like, hey, business is the strongest it's ever been. We hear people talking about a pullback in investment, but we haven't seen it. And this is where you kind of look at the tale of two cities of what's going on in the economy right now. You have people like this Uber driver who's trying to get a job, but he can't get a damn call back, which is a pisser to people who want to provide more value and want to work and want to make more money and want to be successful, but they can't get a job. Why? Because the people doing all the spending right now are the corporations, and those aren't even people, okay? These entities, they're doing the spending. That's why we see the NVIDIA boom. That's why we see enterprise AI boom. It's not because consumers are spending more and they're doing perfect. It's all the enterprise that's doing well. They're propping up GDP. So as they're propping up GDP, the Fed then looks and says, oh, well, hiring's still stable. It's not weakening the way we thought it would. Okay, well, I guess we're going to have to stay higher for longer. That just ends up hurting the normal person even more. Along with the fact that oil went up 2.5%. Brent's almost at $90. And the 10-year Treasury yield went up 9 basis points to 4.18. It's crazy. In other words, big bottom line out of all of this is there's so much confusing data when you're trending either out of a recession or into a recession that nobody frickin' knows. The reality appears to be a simple bottom line. We're going to have higher rates for more time. That enables us to buy the dip more unless there's some kind of black swan that destroys everything, which appears unlikely. The economy seems too strong for that, but nobody knows. That's why we call it a black swan. We don't know what could happen. And on top of that, it's the individual consumer who is feeling pressure. Their wages haven't gone up as much as inflation has gone up, even though real wage growth has gone positive. It's been nowhere near as much as we have needed. And when you factor all of this together, you start saying, okay, so basic bottom line, the rich are getting richer and the poor get poorer. An increasing wealth gap. That's literally what you have. Higher for longer is increasing wealth gap. Apple is able to borrow at 4% for a 10-year mortgage, so to speak. I'm using mortgage as an example. They'll sell bonds. They're able to borrow at 10% or at 4% for 10 years. And then they take that cash and can throw it into money markets and earn 5.5%. They're getting paid to borrow money. They're getting paid to do their CapEx on the backs of workers who are suffering more under higher for longer. However, supposedly the Fed also realizes this and wants to avoid increasing pain. So we're just in an era of uncertainty. And frankly, usually in eras of uncertainty, are some of the best times to invest in stocks. You just have to be choosy with where you're investing. Thanks so much for watching. We'll see you in the next one.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.